Welcome to the DSG Podcast, exploring the intersection of on-chain and traditional finance. As a digital securities platform committed to open finance, we bring you insightful conversations with industry leaders and innovators, exploring the evolution of capital markets. Whether you're a finance professional trying to raise capital or curious about on-chain finance, tune in for grounded perspectives on where finance is headed. The content shared in this podcast is for informational purposes only and does not constitute financial, legal, or investment advice. DSG does not endorse any specific investment strategies or provide advice specific to any individual's circumstances. Listeners should consult their own investment advisors before making any decisions based on the information provided. Now let's get started.
Okay, cool. Hi to my welcome everyone. I'm Tim Maclean. I'm hosting this episode of the DSG Podcast. Today is the 18th of December, 1 week from Christmas, and I'm excited to be joined by Jamie Coutts. Jamie is a chief analyst at Real Vision. I've been following your work, Jamie, and I've found it quite insightful into the way the markets have developed over this year. You've obviously contributed to our magazine, and for which we very much appreciate, and thanks for joining us today.
Hey Tim, it's really nice to be here.
Cool. Well, how about you give us a brief intro to who is Jamie, not the existential version, obviously just the one relevant to how you got into the crypto markets and yeah, what your journey was to get to where you are today.
Yeah, so I started in Australia in finance. I was a stockbroker, working with Credit Suisse for high net worth clients back in sort of the late 90s. So I came in just before that, the first major bubble of that era, which was obviously concentrated in the tech era, which was a very fascinating time to live through. Probably the best thing that could have happened to me from a career perspective. In many ways, it taught me a lot of valuable lessons. But I worked in London, moved into institutional trading, worked on the sell side as an execution trader, then a salesperson, moved out to Singapore, started a business out there, which was on the sell side, and then moved across to become a macro trader at Tudor Capital. And then I spent really 10 years at Bloomberg building out their couple of different products and areas. So we had what was called alpha capture, which was basically capturing trade ideas from the sell side analysts and measuring their performance, something that I was using quite a lot on the buy side. And then I sort of moved into the digital assets space with Bloomberg, whilst I was the equity specialist covering predominantly the sovereign wealth funds and the pension funds in Asia, and sort of built up the digital assets strategy from a sales and a product perspective during 2020 and 2021, then moved across to Bloomberg Intelligence to start the crypto asset research product, where I was the chief analyst there covering crypto assets and the crypto market. And then now here at Real Vision. But if I had to sort of like my TradFi career was predominantly in equities, and that's sort of the lens I bring to the space. But I've always had a very strong macro bent, and I've very much been a devotee of technical analysis, of a disciplined technical analysis, and very much involved in the global Chartered Market Technicians Association. So pretty varied career. And now I think since I moved to digital assets, I feel like it's a new lease on life when it comes to finance after I think a period of a little bit of feeling that things weren't heading in the right direction generally. And next thing you know, this white paper pops up and I started going down the rabbit hole of Bitcoin, and here I am today.
Cool. Is it fair to say that the macro, I suppose, an interest, or the side that you kind of, was it the macro side that really got you into crypto, that kind of understanding some of the problems at a very high level? Do you think that's really what piqued your interest in the digital assets?
I think so. Yeah. I mean, everyone comes into the space with their own sort of backstory and interest. And I would say that I guess that the macro or the monetary system understanding, which really, I'll be perfectly honest, Tim. I mean, I studied economics at university. Everything I had to spend 15 years in the industry to unlearn everything that was taught in tertiary education, quite frankly. So it came late to me, this better understanding of the monetary system and kind of what ails the global economy. So that was one of the reasons why I was very interested in Bitcoin originally, and then in the blockchain technology that came with smart contract platforms and applications thereafter. But yeah, it was one of the reasons, one of the primary reasons why I was interested. There are others, but yeah, that was pretty central.
And would equities and analysis, is that do you think that's a transferable sort of skill set that you find quite useful for the discipline of analyzing kind of crypto or some themes in your work? Is it that, or is it more than just transferable? There are some really sort of similar concepts to analyzing companies, to analyzing projects. Is that how much of it is similar and how much is different? Yeah,
those skills or analytical lenses are transferable, but crypto is obviously this very different beast. So really what it takes to understand crypto is to have a very multidisciplinary approach. Not only when you think about how to frame the asset class, like, is this project more like an equity or a commodity or even a fixed income instrument? Because a lot of the crypto assets have elements of all of these. So it really is like a geek out on this stuff. It is such a fascinating design space to be in, because what has happened through, these people who sort of the developers who started a lot of these products, whether it's the infrastructure layer of blockchains and the applications that come after, a lot of them weren't necessarily finance people. They were engineers. They were software folks. So they just took things from, where it made sense and started tweaking the parameters and creating this entire new asset class. And it has elements of everything, but it also, when I say multidisciplinary, it's like you have to bring a multi-asset sort of lens to the asset class, but you also have to bring a different analytical frameworks as well. So you pull from the macro because of the secular trends that's happening and what's happening with the monetary and liquidity side, and then you have to usually, filter things through a fundamental understanding, and then you have to sort of understand what are the fundamentals that drive prices, like just in terms of an equity, what drives an equity price? Well, obviously increasing sales and improving profit margins, and that can all be quantified in crypto to some degree. There's a lot of debate about it, but to some degree you can do it. And then you just overlay, for me anyway, I think technical analysis is a huge part. You have to understand how to quantify risk in the market and apply that skill set as well. So, as I said, I geek out on it. It's fascinating.
But I'm glad you jumped into the space, and yeah, you must have thought that it was there was probably a few sideways looks at the time, maybe that because I know especially if you were reasonably early, it was always a questionable sort of asset class. Maybe now less so, but yeah. How did you find that? Did it make you doubt the decision, or did you? So that you're feeling.
Yeah, look, I'm human. When you hear other people's opinions, sometimes from people that you respect, talk about the asset classes in sort of the derogative terms that we've all become accustomed to it being labeled as, especially working for one of the propagators of most of the negative news flow in the space. It was, you obviously took some of that on board.
Sorry?
Yeah, it was Bloomberg, and still to this day.
Sorry, you avoided saying that. Sorry, and then I made you say it.
That's sorry. Okay. Yeah, that's okay. It's a reality. Just do a news search.
Yeah, cool.
But I mean, look, the thing is that like there's a certain. I think I've always thrived in an adversarial environment, to be perfectly honest. So I loved it. I mean, the reason why I sort of fell into this space was that I became a thorn in the side of product and sales at Bloomberg globally for demanding more product and a digital assets approach. And I created this. There was sort of a memo that kicked it all off internally. I wrote this report. I wasn't an analyst at the time. I've never really been a research analyst per se up until this point, but I dug my teeth in and did a research report and sent it, and it was pushed all the way up to senior management, and they kind of like grit their teeth and half admitted it was a scam, but maybe it deserves some resources, and that was really the start of it. But throughout that entire time, even moving into Bloomberg Intelligence, where I had my esteemed economists and my esteemed technology and sector analysts, ESG analysts. Hopefully we'll get to the ESG part, because that's the fascinating story about this. And it was a constant battle, but I loved it. I actually did love it. It was more of a case of like when people I didn't know who I respected, maybe on Twitter and other places, were talking negatively about it, and I thought, am I missing something here? Am I really that gullible?
Yeah. No, I definitely had that those moments as well, as being like, yeah. But I think that it's kind of healthy, and it's good to doubt yourself occasionally. But no, thanks for that background. So maybe start with, if you could, just walking us through how you think we've got here to this particular point with the cycle, and what we're looking at, heading into next year.
Well, let's sort of take a step back and look at like the big secular trends that are driving everything, because everyone at the moment is hyper focused. I don't know if you've noticed, hyper focused on the cycle peak, like when's it going to top. We've all become accustomed to reading cycles like they play out like clockwork, and there's definitely symmetry in this market, and it's fascinating to see it, and it is likely to follow that trajectory and path. But really what I try to instill when talking in a lot of the research that I do is this is a secular trend that's taking place. This is a long-term technology adoption trend that's intersecting with a secular economic or monetary trend, which is the current financial system, the fiat-based, credit-based, fractional reserve-based monetary system. And the reason why the asset class has done well is because it's the intersection of these two secular trends that's meeting a global demand that wasn't being met before. So that drives adoption from a couple of fringe libertarian cypherpunks to early adopters to the first institutions being VCs, maybe the first fund managers, more and more individuals, because it's very much a grassroots, bottom up, not top down enforced adoption curve. And then it starts to, it actually starts to infect the higher echelons of the sort of hierarchy of institutions. And now we're at the nation state level. Nation states are actively talking about adopting or using Bitcoin as a reserve asset on their balance sheets. So whether that happens en masse, we'll have to wait and see. I personally think it's already started. But the point is that to have that discussion 2 years ago, 4 years ago, would have got you laughed out of the room. So that's really the Bitcoin explainer. Now, everything that's happening outside of that is very interesting, because there's much more utility in the other blockchains than just transfer of value, store of value, an asset that's going to actually appreciate over time because it has these certain monetary properties, like a hard cap of 21 million, a disinflationary supply schedule, the world's largest compute force securing it, larger than any Google data centers or combined data centers of the large big tech companies. That's the size of the Bitcoin network. Outside of it, you've got these other smart contract platforms, and they have different properties. They don't have the same sort of hard money properties as Bitcoin. They are reasonably inflationary, like our fiat currencies are, but they're providing utility. They're providing platforms upon which applications and services can be built very, very cheaply and very, very profitably to try and address the other parts of the monetary system that are failing a lot of people, maybe not us in Australia and New Zealand because we have functioning banking services. Well, I would say that the extraction of fees is obscene, and that in and of itself argues for blockchain technology and will cause blockchain adoption. But for the rest who don't have banking services or who live in jurisdictions where it's hyperinflationary or they don't have they're being deplatformed, they're being censored. All of this other type of monetary technology is of great value to them. And then you've got all the sort of let's just say less what would be the right term? More fun stuff, right? Whether it's trading memes to appease the gambling nature of people, whether it's more constructive things like bootstrapping new networks through like decentralized physical infrastructure or ticketing and AI, like there's a whole scope there. So that's really these are the big secular trends. So bringing it back to sort of your question, sorry for the long ramble, is like,
no, it's good.
This has got a long way to go. Now the cycles, if you look at it as from a cycle and the amplitudes of those cycles, they're huge, massive up years. Usually a severe down year, something greater than the volatility of any other asset class, but the asset class marches on. So, everyone's sort of like wanting to make as much money in the cycle and taking all the risks so they can get out. And that's probably going to cause, a heated frenzy next year. You can certainly see the signs of it. So, we can talk about specifics of that, but that's kind of like where I'm sort of at. Like, this is a long-term allocation and, the pension funds are coming in, the nation states are coming in. They're not trying to pick cycles. They're going to allocate.
Yeah.
And that underwrites adoption.
That's it's an interesting perspective from somebody with a technical analysis background as well, because you're saying effectively zoom out. Don't focus on when this thing turns for the 6 to 8 months maybe, and then it cools down again and goes backward. You're saying sort of stand back and sort of watch this happen over a longer period and be patient. Maybe is that your view?
Well,
with how
it's a bit of both, because a lot of the research I do and where the market demand is for a lot of the research at the moment is really being much more short to medium term orientated. So I'm most certainly at Real Vision, and the pro crypto research product there is talking about where we get to this cycle potentially. These are the potential pathways and outcomes. This is what it means for the DeFi sector, the infrastructure sector, for AI blockchain coins or assets, sort of forecasting that, managing risk, potentially where you'd want to take some chips off the table because some of the expected returns will be very large. But also just reminding people that if you are more long-term in your thinking, which is really where the opportunities lie, I believe, and that's taken me a long time to realize as well, is you want to stay exposed to these secular trends. We can all try to time the market, and some of us are very good at it. Some of us are not very good at it. But the best players, are guys like Bezos, who just took his Amazon stock and never sold it through a 25-year hyper technology cycle, and now he's one of the richest men. Same with Tesla, same with Musk and whatnot. If you can afford to be more long term, which is certainly a better way to think about it, then allocate the percentage of your total wealth to the asset class that makes sense for you, that means that you will not lose sleep at night, and then just shut it and read good research and try and get an idea of which assets to be exposed to within the allocation, but don't try and overtrade it and just try and ride this secular trend. The question is, are blockchains going to be used more in 5 years' time than they are today?
And what would be, if you did want to take chips off, what would be this? Would your macro sort of traditional finance thinking, would that determine sort of when and how you would do that, or would you look at the space is a bit more fundamental. I get like fundamentally specific to the sort of asset that you're looking at, whether it be Bitcoin, Ethereum, or whatever. Well, but I guess what I'm trying to go with this is like we're finding that it's somewhat behaving still very similar to a NASDAQ type sort of exposure. Do you think, is that the sort of backdrop to how you see this adoption cycle, or has it got something unique about it? And sort of where do you sort of signpost to maybe take some chips off or risk off, or is it traditional? Like, let's say there's a which I'm sort of seeing a little bit more about. There's some risks to risk assets such as equities, with maybe inflation coming back next year, and maybe interest rates haven't. Maybe it's too soon to be sort of cutting, and that's a policy mistake, for example. Sort of these are the sort of considerations I know you would have dealt with in equities and macroeconomics. Is it something? Do you apply a similar thinking toward maybe how this digital asset space, crypto, how that evolves? Or again, this probably comes back to your long-term view. Sorry, but I guess the question is, how do you think about a good time to maybe de-risk?
So it is still very much global risk assets move with the liquidity cycle. And if you can understand the liquidity cycle, then you can sort of get a better sense. It's not a crystal ball, but you can get a better sense for when risk assets are risky, for lack of a better term, and when they're not.
Yeah.
And so there's different ways to measure global liquidity. And there are folks out there that have done some amazing work around this. Like there's two people which have really informed my framework. And that's obviously Raoul Pal, who's the founder of Real Vision, but also Michael Howell at Capital Wars. These two have really pioneered thinking around liquidity. Now I use a lot of that in my framework, but slightly different. But the point being is that if you just pull up on TradingView, Global M2 or Global Central Bank balance sheets, they're two ways of measuring global liquidity. And so usually what you see is, first you have to understand that global debt to GDP is around 3 times, right? So we are in a debt spiral. And the only way we fix it, well, the only way we treat it at the moment, there are better ways to treat it, but from the central authorities, the best way to treat it is to artificially suppress interest rates and to add liquidity on a constant basis in order to keep the debt from defaulting. It's also aimed at refinancing government debt, because it is mainly government debt which has accounted for the huge amount of global debt to GDP expansion over the last 15 years. After the GFC, the debt's moved from the private sector to governments and public institutions. It's, most countries in Western countries, you're looking at debt to GDP of 100 to 125%. The two main players here, China and America, are over 120%. That's always been the level that, mainstream economists would say, hey, we're in a debt spiral. So how do they address that? They have to add liquidity. Now, the cat's out of the bag in terms of inflation, right? So they have over-egged it because of the COVID response. And now we have inflation in the system. It was already there in asset prices. Look around us, houses in New Zealand, houses in Australia, in Canada, in the United States, whether it's NASDAQ stocks or whether it's Bitcoin, are all expressions of the debasement of currency from adding liquidity, because that is their only tool in their toolkit. They should be addressing it by inspiring growth, GDP growth, and then you can rebalance the debt to GDP equation back to more normalized levels and stop punishing everyone with high inflation. But we're starting to see that come through in this new administration from Trump. But I'll put that to the side for one second and get back to the liquidity piece. So with the debasement that's going on, that sort of encourages, obviously, asset prices to rise, so that new money finds its way into either productive assets or assets which can generate return. So typically it's been in property and assets and Bitcoin and crypto and various other things. If we look at really what's happening at the moment, global M2, global money supply, has had a 18-month period of pretty much sideways movement. That's the longest period of really stable monetary growth that we've seen for many decades. And they know that if they don't start adding liquidity, something is going to break. And it certainly, you'll see it expressed in the US Treasury yields spiking, or the volatility on US Treasuries spiking. So I know inflation is a concern, and it's higher than what we're used to, but get used to it. It's a byproduct of it's byproduct of the financial system. They're going to start messaging that higher inflation is more acceptable. It used to be 2%, then they'll start saying it's 3% okay. And what they'll probably do is less obvious liquidity injections next year. The term QE optically and from a PR perspective is a dead weight. So they'll tweak things, things that the public won't be able to recognize as QE. And they'll keep the system from collapsing, because unless they do, the system could potentially break. So the release valve for increase in liquidity is just people closest to the money printer, big corporations, big companies, wealthy investors go and spend that extra credit that they get from the banks or directly from the central banks. They go and spend it on assets, and that pushes everything up. So I think liquidity has to expand next year, and it's based on my estimates, it'd probably peak out in early 2026. Now, crypto usually sniffs the slowdown in liquidity expansion. It doesn't peak when liquidity peaks. It tends to peak before, because it's pricing in the future. And so, my estimate is, if people sort of want to hear my prediction and call me out when it's wrong, is probably Q3, Q4 next year, we get a peak in crypto asset prices after a pretty strong year. But again, you touched on this point about things are changing with global adoption, nation states are coming in, blah, blah, blah. Will we see the 90% pullback in the Solana that we saw in the last cycle? It depends on how crazy things get next year. But my feeling is no, but I could be wrong. It just depends on how much we overextend to the upside, to bring that sort of drawdown that inevitably comes when central banks and governments start tightening belts again. And that will happen if inflation gets up. So they'll let inflation in the US go from, where is it today? It's about 3. They'll probably let it get to 4, and then they'll start panicking a little bit. But it's a tug of war. They've got to keep the PR machine running, that we're keeping an eye on inflation, while the whole system requires more monetary liquidity to keep itself from deflating or collapsing.
I think that's there's an interesting shift in perspective, which I know I had kind of relatively recently, is that central banks and power, they have a very sizable problem on their hands. And it used to occur to me that why do they keep sort of juicing it almost felt like a buddy relationship with Wall Street, that they want asset prices higher. But what in reality I think you're saying is maybe they don't have a choice, because if they don't increase the liquidity, other parts of the economy suffer, and they're not really concerned that asset prices, well, they have to try and keep a lid on it, otherwise you kind of have a bubble effect maybe or something. But it's a very difficult situation to manage.
Could I just make a point on that, Tim? The thing is, with when they're adding, see, it's you can argue that it's an asset bubble, but it becomes harder to argue to a degree, I would say, because when you look at the denominator, so the currency that you're pricing the asset in is constantly being printed, you're being debased, so that inflates the value of the asset nominally. So we see higher prices and everything. Unfortunately, it's in our goods and services, which is equally problematic, but something that we haven't had much of until the last couple of years. But it's if you just denominate everything, asset prices that is, in the currency that you're forced to use, domestic currency, then and you measure that as sort of like the money stock of New Zealand or the money stock of Australia or the central bank balance sheet of New Zealand or Australia, then you kind of see how asset prices are fairly stable or haven't increased a lot versus the money supply. Some assets do better, and that's the reason why I allocate to crypto.
Yeah, no, that is a good point, and that's something I think it's really, I think the bias is to devalue that denominator, of course, but you wonder what incentives are there to stop that devaluation if things get frothy. I think I was sort of leaning towards, but then like the pain that it incurs with stopping that devaluation comes back to the reasons why the system needs liquidity, because we've got such high debt, and there's really we really don't want that kind of situation, I guess, with and we've sort of experienced it a little bit here in New Zealand and possibly Australia, when things get tight and you stop. There's a lot of economic activity that's lost as a result. And I think it comes back to your point with Trump and the way they're sort of looking at things is we've got to grow our way out of the problem. Not we can't keep just relying on central banks and governments to spend and things. We've got to get the private sector going and deregulation. And I think that's interesting. And I wonder, I guess, I think so we have the fascination with house prices, as do you guys. Probably, I think we win this one maybe with no capital gains tax here and things, the other incentives that somehow survive today. But, I know a lot perhaps are thinking that's not the best way to play this, and maybe are you seeing trends at the adoption be different for different generations, or is there any demographic type biases in the market at the moment? Is that something you kind of look at, or and the other sort of follow-up point, sorry, is how do you see things happening in New Zealand and Australia, and perhaps if that is unique as a Antipodean market to that relative to, say, the US, which is now very, you could argue, very disruptive or pro disruption and innovation, and maybe EU is not so much like that at the moment. Where would you put? I sometimes, I can give you my answer first. I sometimes put like New Zealand sits somehow culturally, and we kind of straddle both Europe and America, in that we've got both of that in the way we think in a lot of ways. But I don't know what your thoughts about that. So I've got how does New Zealand and Australia compare to the rest of the world, and really is there a demographic bias in the way these trends are unfolding?
Well, let me touch on the demographics. So there's a huge divide, which is, I think, maybe starting to narrow a little bit now that you've got ETFs for Bitcoin and Ethereum and more to follow, because that's a product that boomers will access and invest into because BlackRock told them it's okay. But it's all a function of the societal socioeconomic trends, right? So young people are obviously technology or internet natives, digital natives. So they're comfortable with the concepts of a digital wallet, which for an older generation person, they are not. They see the banks as being safe. Whereas young people would consider, a digital wallet safe as long as they manage the security key or the keys and the measures around that. But it's also just a function of the fact that the system is incredibly unfavorable for young people when it comes to assets like property. Like you ask a young kid today, they want to own a home. They want to own the nice house in the nice suburb. But in Australia, like Sydney specifically, 13 times median wage is the average house price. Now that used to be 3 when our parents were growing up. So we can bash the younger generations for being degenerates who want to go and invest in meme coins, but we've created a system that's functionally against them. This coddling of the housing industry by banks and government to engender support from the boomer generation has completely penalized the younger generation. So there is a huge change in their thinking. And look, you only need to look at the chart. Like Bitcoin has outperformed everything. So when you ask a young kid what would they rather invest in, they would say Bitcoin because they can see the chart, they can see what's happened to housing, and they say, well, this is my way to prosperity. And that is basically bootstrapped a monetary network that has all this utility for various other parts of the economy and stratas of the hierarchy. And so they're absolutely correct because, they still want property. Bitcoin's the way to do it. And now, went from individuals to nation states as being a reserve asset, and they'll be proven right. And that will suck in more and more people. I mean, it's like it's been referred to as the black hole. It's going to suck everything in. And when you think about how assets need to move in a digital world, they can only move friction-free via blockchains. And you've got BlackRock building on blockchains, and every major institution now who's sensible is also looking to integrate or has a strategy around it. We're going to see 24-hour trading of stocks, bonds, commodities, alternative assets, all done on blockchains, in the years to come. So it's kind of like, it's all these intersecting trends. So the demographic differences are true. And in Australia and New Zealand, the surveys that I've seen, it's like 26% of people thereabouts have either bought digital currency or still own digital currency, but it's skewed to the younger generation. Now the ETFs are creating a product access point for older generations, so that's just going to converge, and that just pushes the asset class up. In terms of just like where we sort of sit here in Australia, my mother's a Kiwi, so I spent a large part of my growing up and formative years in New Zealand, seeing family. Lived there for a very brief period when I can't remember, I was too young. But I'll refrain from commenting on New Zealand and stick to Australia, which is my country. Not to get into too much hot water with your viewers, but I mean, Australia used to be a very liberal economy, much more sort of orientated towards the US, but it has really become a European Union type structure with huge amount of government overreach and skewed in economic incentives. I mean, the only thing that's growing in Australia is the national disability insurance scheme in terms of wages and employees. Private sector employees are dropping off a cliff. Real wages are dropping off a cliff. But at this point, we're growing the amount of public servants and 8% of people in Australia are disabled, amazingly, right? So the incentives from government in as goodwill as they are, has reached a point where it's killing private sector growth. And that is very much the European Union setup. It doesn't take much to turn things around, but no, we're heading in the European Union direction rather than the US direction right now.
Yeah, I'd hope to say we've at least got ambition here in New Zealand, I think, to be innovative. It is hard, and I think like I said before, I think some of this blockchain technology it can really support small markets on the end of the world like ours, because it disrupts big tech in a way, although we haven't seen that necessarily. But if we can use this technology without having to rely on centralized middle parties that abstract monopoly rents effectively from their giant infrastructure moat, then we can develop new systems. One of the things I think DSG is interested in pursuing is working out how governments can kind of like use as an infrastructure sort of perhaps like a T-bill that could be tokenized or something, or a treasury related product, and then DeFi could be built on top. We're small markets where we can test stuff like that, and there's little cost and associated with implementing a smaller version of that. And we've got a regulator who's kind of keen to working with us in sort of sandbox arrangements and understanding new ways of doing things. So I think I'd say we're cautiously optimistic, or we're sort of, we like to see new technology as opportunities. It's just we can be kind of risk averse, I think, as much as it boils it down to it, particularly when you see the global market do something and then we reflect that twice almost. We sort of, our businesses, and we shut up and we stop spending. Yeah, we're sort of quite insular, I guess, in some regards. But so I've got sort of a foot in both camps.
It's a huge opportunity. Huge opportunity. So I don't know what it is for New Zealand, but global economy, GDP is around 100 trillion. 20% of that is financial services. Now, financial service, like banks and financial companies, provide amazing services, but they extract too much from the economy, right, from the citizens. So, 6% cross-border payments, 3 to 5 day settlements. New Zealand's an export economy. What if you had cross-border payments and cross-border settlement, which was instantaneous, free, that was locked into the banks backed by New Zealand stablecoin, which when DeFi was enabled, and then identity, blockchain, zero knowledge proof identity technology integrated into the government system, so that the government databases don't become honeypots for scammers and for hackers, which they're the worst at keeping secrets. All this technology is at their fingertips, but they would prefer to go down the path of one big database controlling it, and then having every department be able to see every bit of information about their personal people, because it gives them a lot of control. But ultimately what unlocks economic potential is the sense that you're secure and you're free. And so you should be able to provide what you need to provide to the relevant parties, but not provide everything. That technology exists, and it's custom built for governments if they would just adopt it. In election integrity on blockchains is starting to be rolled out in South America, and even in Georgia in the United States it was used. I mean, this technology has amazing potential. It just requires leadership from our political parties to adopt.
Yeah, and I think you might have seen that there's a banking inquiry in New Zealand, and of course you've got Australian-owned banks extracting these profits from New Zealand as well, and that's something that's a bit topical at the moment, and something I suppose we can blame you for. But there's opportunity everywhere, and I think there's going to be, I think that being too risk averse, there's going to be things that might not work. It's just about managing that, and I think we're on the same page there. This has been a very interesting chat, Jamie. I've got a few more things I'd like to cover. I don't know how you're going for time, but
sure.
Maybe just a few. So you've probably touched on a few real-world applications, election integrity. Are you seeing? I know a key part of our DSG vision is to seeing more traditional finance moving to blockchain. I've noticed a sort of I had a fascination with DeFi in the early stages. But just it's sort of it more evolved as a thought experiment in my view, because it was so sort of I'm not sure if it's debanking or risk, or people not seeing it as being a thing that could be useful in everyday life. I don't know how you see systems evolving or merging, or whether we'll see more real life applications in banking and payments, or whether it continues to be a tug of war of sorts, or how that evolves, or do the big players get involved? You mentioned BlackRock and stuff, but how do you see the real world blockchain being adopted in real world? And
Watch this space. It is going to be unreal what we see in the next couple of years. You've got a Fed governor, Governor Waller, who is apparently like quite high up in the hierarchy there. Go online and look at his presentation from September, where he talks about how complementary DeFi is to the banking system, right? So he's very sort of pragmatic about it. Like, there are risks, but the ability to create efficiencies across banking functions, which through technology is immense and would be a major unlock for global economic activity. So it's permeating the various highest echelons of the centralized institutions. Now you've got institutions like the the ECB, which write hit pieces all the time, which are hilarious. They are to be bookmarked for future reference because they clearly don't get it. But the EU itself has brought in regulatory frameworks at least to try and engender a digital asset ecosystem in the EU. So look, the institutions, BlackRock being the most noteworthy, they see huge opportunity to disrupt rather than be disrupted, right? So they want effectively, to obviously increase. They have a profit incentive. Why would they be aggressively pursuing tokenization on public blockchains like Ethereum? It's because they just see the benefits of what this technology can bring. And if you look at, like, even today, I'm writing a report for Real Vision Pro Crypto on the DeFi sector, and I tell you what, it's mind blowing. The fee revenue from DeFi protocols, just the top 200 DeFi, well, the top 200 index, of which there's about 30 protocols that are DeFi orientated. So that's decentralized exchanges, decentralized derivatives, lending protocols. If you aggregate their daily fees, it's about 27 million per day in fees that are actually generated on these protocols. So you annualize that up, that's $9.9 billion per year. When you think about these, as a sector, decentralized exchanges, they rank number 7th in the world versus global trading exchanges. So that is the NYSE, that's the Chicago Board of Exchange, that's the NASDAQ. So, Coinbase is number 5 actually already, right? And it only has 10% of crypto spot volume. It's number 5, higher than the NASDAQ in terms of fees. So what they're doing is providing the venue upon which more assets will eventually come to actually move more freely and friction-free on better technology. And these decentralized exchanges and other, the other DeFi Legos, the composable other parts of finance which interface with decentralized exchanges like lending and fixed income products, they're all just set up for waiting for the increase in volume that's going to come through from the likes of BlackRock adding products and tokenizing government bonds and whatnot. So pretty bullish.
Yeah, that does sound bullish. I've also it is quite hard to explain to people, not sort of to try and sell the benefits, but I think because it's like, well, it works currently, and then it's like, well, does it work? A lot of so for example, prudential regulation, so what capital banks have to keep, it's all sort of managed by teams with on spreadsheets, and part of the biggest problem is what happens if you record things incorrectly, and how do you know, how do you see where is it transparent in terms of the collateral that banks hold, and then you think of this utopian banking system where all of that's available instantaneously on immutable ledger. It's like, gosh, why aren't we building that now? But obviously there's incentives, and then there's regulation, and then so I'm a bit more, in terms of the way I fit with DSG. I know I'm the less of the sort of the builder type entrepreneurial. It's all going to be amazing, and it's like all these little practical problems that I focus on in terms of getting extra steps. It seems like sometimes it's just a march through this regulation and the way in which people are familiar with the way things are, and then but it is still ultimately exciting, because that end goal, I think, is while aspirational, it's achievable, and so I'd agree with your views that long term we'll see a lot of adoption in this space and more people seeing the benefits. But I think I've really enjoyed speaking to you, Jamie. I've enjoyed your research. And I wonder finally if you have any thoughts that you could share on people who are new to this space, or how people can follow your work, and any advice you've got for anyone just curious about crypto.
Yeah, look, I mean, it's hard to give generalized advice, because everyone has, firstly, I'm not an advisor. Everyone's risk profile is different. But if I just to sort of give very generalized advice, is ask yourself the question: are we going to be more digital in 5 years' time? And does the world need to solve this global debt to GDP problem without blowing itself up with more debt? The answers to both of those questions are yes. How do you play it? There's lots of different ways you can play it. There are excellent equities, growth equities, and then there are, a growth asset class in and of itself, which is crypto. So if you can afford to take a long-term view, even though the market is up a lot and feels very frothy, if you can take a long-term view on this and look through this cycle, then I think, an allocation is at this point absolutely deserved. The percentage of allocation is a personal question that you've got to resolve based on your risk profile. You can catch my research. A lot of it goes up on Twitter. My handle is Jamie @Jamie1 Coutts. And you can find me at Real Vision. So Real Vision is a financial and Web3 research company and entertainment company, basically providing global macro and crypto-based research, but explores all the different pockets of crypto and all the different pockets of macro. So whether you're a traditional person, traditional investor, and want to invest in just the traditional asset class, Raoul Pal's work is undoubtedly one of the best in the world. The product there is amazing. I'm privileged just to be a part of it. The Pro Crypto product, which is my product, is research reports, but you get a ton of interviews with some of the best minds in the space. So it's worth checking out. Otherwise you can always catch me on Twitter.
Awesome. Thanks, Jamie.